And a very warm welcome to you. This is World Business Report with me, Alice Baxter. Now, it's another day and another drop in the value of China's currency, despite the country's central bank saying that Tuesday's move to depreciate the yuan was, quote, a one-off. Well, the reduction of 1.6% brings the yuan to its lowest level against the dollar for 4 years. The move will benefit Chinese exporters by making their products cheaper abroad. Well, with me here in the studio is our business correspondent, Theo Leggett. Good to see you, Theo. Theo, we've heard from the People's Bank of China, the central bank in the country, going to quite some lengths to allay concerns in the market that China is deliberately embarking on a concerted campaign of sustained, weakening its currency over a sustained period in the face of stalling economic growth. So if they're not doing that, what is going on here?
Well, let's look at the way China allows the yuan to trade. It's trapped within a narrow band, 2% either side of a central reference point. And that central reference point in the past has been decided on by the People's Bank of China on fairly arbitrary criteria, whatever its policy objectives might be, and no matter what's happening in terms of the actual trading direction. Now, what's changed is that the Bank of China now says it'll set that reference point taking account of what's been happening on the foreign exchange markets. So, for example, if today the yuan was declining, then tomorrow's fix might be lower. Of course, it doesn't have to allow that to happen because the Bank of China can always intervene in the currency markets and buy yuan in order to bring its level back up. And there is some evidence that that's what they did towards the end of the trading day today.
Now, of course, our headline is that this is making things cheaper for Chinese exporters. We are talking, though, of a total movement of 3%, which for many companies is actually not that big a deal. However, if it does continue to devalue, then we could see some major winners and losers with regards to those who do business with China.
Absolutely. It's whether or not this fall is sustained, and some critics of Chinese policy think that that is the ultimate objective, to allow the yuan to depreciate by a much higher margin. If that were to happen, it would certainly attract criticism in the United States, for example, where manufacturers complain that Chinese imports are already too cheap. It would also have an effect on people who want to sell into the Chinese market. And this is very important for people like European car makers who see China as a big growth market because they can't grow in Europe anymore. Luxury goods makers who see China as a very, very attractive market. So we're talking the likes of, say, BMW or Burberry. Companies like that sell into China. It's an important market. If their goods become effectively more expensive, their room for growth might be narrowed and profits would decline.
Interesting. Sadly, no time to talk to you about how this might affect China's ongoing lobbying campaign to the IMF to become a reserve currency, well, amongst its basket. But we're going to have to leave it there. Good to talk to you, Theo Leggett there, our business correspondent. Well, let's stick in Asia because China's e-commerce giant Alibaba missed profit expectations, reporting its slowest quarterly growth in 3 years. Revenue was $3.2 billion, up 28% compared with last year, but lower than analysts' expectations of $3.39 billion US. Now, the drop in revenue growth comes following a big spending spree. Let's just take a look at what the company's been busy buying. Well, this week it announced that it was investing $4.6 billion in a Chinese retail chain in order to link its online and offline activities. And last month, Alibaba said it would invest around $1 billion in its cloud computing business. And then in June, it launched an online bank aimed at serving smaller businesses. So are shareholders happy with these moves, or is Jack Ma being over-ambitious? Let's talk now to Michelle Fleury, who's on the floor of the New York Stock Exchange. And Michelle, I was just talking us through there the spending spree that Alibaba's been on, because it's important to put this into context, isn't it? The company is still growing, just not as quickly as it once was.
No, and I think that is investors' concern. One, that this internet company is not growing as fast as investors would like. The second thing is that Alibaba's fortunes can't be uncoupled or separated, if you like, from the fortunes of China's economy. If you look at where Alibaba has traditionally done well in sort of more sophisticated urban areas, it's saturated those markets. So how will it grow? The company has said and admitted that it's going to focus in the future on developing and expanding its networks into more rural communities. But for now, where does that leave it in terms of sort of future revenue growth? And that's really what's troubling investors.
But when we actually look at the active user base, the number of buyers using the site, Michelle, those numbers are still quite healthy. They rose 32% to 367 million.
Well, if you break that number down even further, Alice, and look at sort of where those users are coming from, a growing number are actually using the company's sort of services, different platforms, accessing it via their cell phones, via their mobile or their smartphones. What that means is that if you're accessing it through a smartphone or a tablet computer, well, that's good news on the one hand, and that's how more of us are sort of using the internet. But the bad news is that companies like Alibaba make less money from advertising and other revenue sources in this way. And that's sort of another concern that's really troubling investors right now.
Yeah, indeed. OK, Michelle, good to talk to you. Michelle Fleury there for us on the floor of the New York Stock Exchange. Well, again, staying in the region, and Chinese authorities have a new plan for stimulating that sluggish economy. Tourism. The government's ramping up its support for the industry and aims to double its leisure spend by 2020. A new investment fund will be created and new tourist attractions are going to be built. Well, let's talk to Jeffrey Lippman. He joins me live now from Brussels. He's the president of the International Council of Tourism Partners and for many years has been working with the Chinese government on this long-term tourism strategy. Many thanks for joining me here on the show, Mr. Lippman. I read a figure in the China Daily, the state-owned newspaper, that over the next 3 years, the government intends to spend around $490 billion or 3 trillion yuan on tourism investment. I don't know if that number is totally correct. It's a huge number, though. Talk me through the amount of money the government's investing in this and how it's going to spend the money.
Well, the government's going to spend the money on promoting activities which increase consumption. We know this. It's moving from an investment-based economy to a consumption-based economy. And it's got a massive number of consumers who are moving into the middle classes in China. And the way to keep them happy is to allow them to enjoy themselves, to have some leisure time, and to be able to enjoy the incredible tourist facilities of China. So it's simply a shifting of funds into an area which in turn will move people around, get them to spend money instead of saving it, and this will be a terrific economic stimulus.
Yeah, there's going to be new
and at the same time, if I can add, listening to your earlier conversation, if the currency is devalued, this will also mean, even a small devaluation, an incentive for people to travel at home rather than to spend money abroad, and an incentive for foreign visitors to come to visit China. So it's kind of win-win-win.
OK, strong endorsement there. Jeffrey Lippman, great to get your thoughts joining us there live from Brussels. OK, from me and the team, that's all we have for you for this hour. But many thanks for joining us here on the programme, and do stick with us here on BBC World News. Still a lot to come.